Good morning, option strat traders. Normally I don't post this close together, but I've got an opportunity here that I wanted to make sure that I took advantage of to share with everyone. So yesterday, as you recall, go back and specifically look at the YouTube video from yesterday where I talked about buying a single long put on SPY. And the impetus or the reason behind that, and again, this is all paper trading, the reason behind that is that we were right into this trend line, and I was thinking there was a likelihood that we would move back down a little bit from here. Exactly how far we move, etc., not sure. My expectation might be down to around the 400 range, somewhere in there. But I anticipated that there was a higher than 50% likelihood of a down move. And therefore, I proposed, again, paper trading, just buying a single long put in SPY, which we did. And this is how that position is performing right now. So that long put, the May 5th 410 long put, is up $103. So that's where our dashed line is here. So what has happened in this is as the market continues to go down, go in our favor, this is working in our favor, of course, for profitability. However, theta decay continues to play a part in this. We are, if we look at our various Greeks here, and depending on your level of service, you may or may not have all this, but if we look at our various Greeks here, we have a negative $10 in theta. So that means that if everything else stayed equal, it's costing us about $10 a day on average to maintain this trade right now. Now, theta accelerates the closer you get to expiration. And again, theta is a theoretical number designed to give us kind of a general concept or idea. So let's come back to where we're just one day into this trade. And you can see one day into this trade, and the pullback that we've had, we're up the amount that we're showing up there of about $105. So what might we do with this at this point? And maybe it's too early, maybe it depends on your opinion of the market, but what I had proposed yesterday was if we start to get this sell-off, right now we have a maximum loss of $704 if the market were to go back up and stay up there and our long put decayed above the $410 range. But as you'll recall, yesterday in the video I said, if we get this sell-off, at some point you may want to sell a single short put against this long put. So this gives me the opportunity to show you what that might look like. So if I come in and I include this short put that I would sell at $395, we can see that selling that short put, while it does cap our maximum gain in around the $1,200 range, it reduced our maximum loss from $700 down to $339. So that basically tells me that I'm getting approximately $4 for selling that put. Now you can see this used to be our break-even line here, and now our break-even line is here. So that improves our break-even line as well. Now, of course, you can play with this. Maybe I don't want to go all the way down to the 395s. Maybe I want to sell the 400s. So if I sell the 400s, that reduces my upside risk even less because, of course, if I'm selling a 400 put, I'm going to get more money for that than I would get for a 395 put. So selling that 400 put, it does cap my max gain now at 400 because I won't partake in any additional profits once we were to get to that downside mark, if you will. So it's all about the trade-off of what your risk reward, what is it you're looking for. So again, right now, let's just say that we sell the 400. Now we've reduced this risk from $700 to our maximum risk in this trade is $223. Again, that's because we paid about $7 for this, and then we're going to get about $5 for this, and that's what comes together to make up this max risk of $200. Now, if you want to carry this concept even further, and again, this is great paper trading stuff here. If you want to carry this concept even further, if the market were to continue selling off, another logical thing that people might consider doing here is to turn this whole position into a condor. So in order to do that, we can come in, we can add another short put. So we would sell yet another put at some point lower, maybe 390. And let me narrow in my chart range here as well. But you can see now we have one long put, we have two short puts, which gives us unlimited risk to the downside. Of course, nobody wants unlimited risk to the downside in most cases. So now let's add in a long put at a lower, at a lower point. So I'm going to buy a single put, and let me make that one down here, wherever, 385, somewhere in that general range. So again, you can of course play with this, but by selling this additional put spread, we've even reduced our risk further. Now we have reduced our risk to a maximum of $97 in this case. And that's because on our long put, we sold this short put, and then we sold a lower put spread, which brought even more money into this trade. Now, am I proposing that on this paper trade you go and add this short put right now? Not necessarily. I would say maybe sell this short put. Then if the market continues to sell off, consider something like this. And again, this is all practice. This is all paper. Consider some alternative put spread that would give you even more money yet. Many times you can work a position like this into a no-lose position where both wings are above break even. So no matter what happens in the trade at that point, you are at least going to have some sort of profit. So that's what layering into a position can do for you. This is the type of thing I try to teach to my students all the time, is whether you enter with a single long put and then you add a short put to it, or whether you enter with one spread and then you layer in a second spread, or you enter with one butterfly, layer in a second butterfly, etc. These are the types of things that options traders try to work towards. They try to work into a position that ultimately would have no risk on either side. Then you can just sort of let that thing decay under the tent and choose what profit level you might choose to take that out. And again, many of our trades are multiples. So if we have on 5 or 10 of these, we may take 2 or 3 off when we hit $200 or $300 in profit. Then we may take another 2 or 3 off when we hit a $400 profit target. So again, the ultimate goal here is to try to work your way into a position like this. And let me just come and turn these off again. And I'm going to turn them back on one at a time so that everybody can see exactly what's happening here. So again, we started yesterday with this proposed position, 704 in risk. And right now, we're up about $104. The market is selling off. Now, keep in mind, the more this market sells off, the more money I'll be able to get for whatever put I choose to sell. So at some point, I would go ahead and sell that put, end up in a position like this, which is a great position because I've got $224 in risk and I've got a potential almost $800 in gain if the market were to sell off. And then during a sell-off, if a sell-off continued here, at some point I could choose to sell this spread. Again, I would never propose having just a naked short like this, which has unlimited risk, but you put on a spread on the other side and you turn that position into something like this, where your maximum risk now is, in this case, if I did this all right now, my maximum risk would be $70. But again, my proposal might be to wait, see if you get more of a sell-off in the next day or two, then add the 395, 385 spread. So my goal here is to show people how to practice paper trading and getting into these various types of positions. Your positions don't have to all be put on at the same time. Again, you can layer into them and build, in some cases, a much more effective position with a much better risk-reward profile. So hopefully you found this helpful, and I will continue contributing here as ideas come up. Take care.